So yeah, so the first thing that you have to even understand before I start teaching buyers or anything is to understand the way smart money condition the market. So the first thing we're going to look at is consolidation, right? When we talk about consolidation, that is when the market is moving in the same zone over and over, right? The market is neither making highs nor lows. So when you go to the market and you realize that the market is stuck at the same zone, and let's say there is a box over here, and the market is stuck in that box, it is neither moving outside the box, it is just stuck inside. Whenever smart money is doing this, all what they are doing over here is they are building liquidity. So they do this to trick impatient traders to take trade. Do you get it? So they do this to build liquidity, and then get to a point where they will take one side of the liquidity. And immediately after taking one side of the liquidity, they will go for the next side of the liquidity. So your bias is going to help you know which side of the liquidity they are going to take. Do you get it? Yes. So that is the first thing you have to take note of. Now that I have said this, the second thing that you have to also take note of is that for T-trace factor model and for ICT, we find our bias using internal range liquidity and external range liquidity, which I know you know of already because you said you've been watching my YouTube videos, and I have a lot of lessons on that. I hope you know about that already.
Yeah.
So now, when you're finding your bias, right, the first thing is to find what the market is doing, right? To find the market structure. Is the market bullish? Is the market bearish? Or is the market consolidating? Now, if the market is consolidating, you should just know that that is smart money doing that. And you have to wait for there to be a manipulation and then you position yourself, right? So when you go to the market and then the market is making higher high, higher lows, higher high, higher lows, higher high, and then higher lows, continue higher high, higher lows, then you should know that the market is in an uptrend. Another characteristic of an uptrend is that down close candles, right? Down close candles will be supporting price to move higher. So series of down close candles, which are changing state of delivery, will be supporting price to go higher. Another characteristic is that if we are in a bullish trend, logically it makes sense that bullish FEGs are going to support price. And if we are in a bullish trend, logically it makes sense that bearish FEGs or bearish PDRs are going to get disrespected. So the market is all about it's not anything difficult. You just have to get the understanding that if I am bullish, then the market is going to be strong enough to disrespect bearish PDRs and to respect bullish PDRs. So that is the first thing that you have to put it in your mind. Now, when I was starting, I said that the smart money conditions the market by causing the market to consolidate so that they can trick impatient traders to take trade, people who cannot sit on their hands. Now, whenever you have a large expansion, right? Whenever you get a large expansion, it is usually followed by a retracement, right? Or mostly a large expansion is usually followed by a consolidation, right? Mostly a large expansion. When you get a large expansion, it's usually followed by a consolidation, mostly. Do you get it? Now, smart money moves the price largely and then they consolidate it so that they can trick those traders who couldn't participate in this trade to come and participate in the one over here, right? Now, let's assume that you are in a bullish trade, your bias is bullish, and then you see that price is consolidating this way. Now, a consolidation should always be followed by an expansion. From consolidation, we go to expansion. From consolidation, we do not come to retracement. Retracement is when the market comes down to target point of interest and then goes up. That is retracement. From consolidation, logically we have to be expand, right? So from consolidation, we do not expect reversal. Reversal is when the market change trend, right? So in a situation where you have a consolidation and then the market retraces, then you should know that that is a trick, that is a manipulation. So those traders who were afraid or who couldn't participate in this big move and rather wanted to participate in this consolidated move will place their stop loss over here. And then you realize that smart money will come and take their stop loss, tag, let's say, a fair value gap over here, and then move. Do you get it? So whenever you see a consolidation this way, mostly price will manipulate, tag a point of interest, and then move. Do you get it? So let's already another thing, right? Another thing is if you are already in a bullish move, if your bullish move is confirmed, sometimes smart money will just continue on the move from the expansion, from the consolidation phase, and then there will be a fair value gap that the market will later come to that fair value gap, right? Let's say you had your market structure shift over here, and you've confirmed that you're bullish, and then the market will come to the fair value gap and move. But mostly it will just choose to take the consolidation moves and then move, right? So the reason why I'm even doing this is when you find your bias, which we are going to go over today, we are going to learn how to find bias, right? When you find your bias, and let's say that price tags, price tags your fair value gap. So let's say that this situation, you've identified that price is bearish, right? So let's say that price is bearish over here, and then it's it goes up. So let me just draw it this way. So let's say that you're in a bearish market, right? So bearish market goes this way. In bearish markets, we are attacking lows, we are attacking lows, we are attacking lows. All what the market is doing over here is whenever the market goes up, it goes up to tag a point of interest, and it is mostly a fair value gap. So it will tag that fair value gap, and then it will rate external range liquidity, which is a swing point, a swing low. And then it will come and tag a fair value gap again, and then it will rate a swing low in that order continuously as long as the market is in a bearish trend, right? Now, if the market wants to, let's say we have a fair value gap over here, if the market wants to turn bullish, that is when you realize that instead of the market respecting this fair value gap and continuing the down move, the market will rather choose to disrespect this fair value gap. And now when the market chooses to disrespect this fair value gap, it will mostly print a bullish fair value gap. Now, when the market comes to that bullish fair value gap, and then it's respected, then you should know that the trend is going to change. And then the market is going to make higher highs, higher lows, higher highs, higher lows. Now, this should tell you that smart money moves the market in two ways. First, they move the market down to build liquidity. And later on, they change the trend to attack those liquidity over here. Now, if this is converted upside down, right? If it is turned upside down, then it will be something like this. That is if it is turned upside down. I don't want to draw much, so something like this. If it is turned upside down, right? I hope you get it. If it is turned upside down, you see that they buy and then later they sell to attack liquidity. So the market moves in two cycles, right? It moves in the sell side and then buy side. If it is this way, sell side, buy side. If it is turned this way too, sell side, sorry, buy side, sell side, right? Now, also, when you pick each of these legs from this to this, which moved over here, when you go to the lower time frame, you get to see that there is a market maker model in this leg. There is a market maker model in this leg. There is a market maker model in this leg. There is a market maker model in this leg. And I believe you know what a market maker model is, right? So is there any question up to this point so that I can move on to the next? Because these are just basic stuff I wanted to brush over. Hello, Big Ten, is there a question from you?
Yeah, I have one question.
Yeah,
Uh,
ask it quickly.
okay. Can you explain how to the best way to understand the open high low close and open low high close.
Okay, so
Because I saw one message you said that this is
oh
the
yeah, yeah,
key
yeah.
in
So
trading. Yeah.
we will definitely get there. You know,
Okay.
yeah, this is just a process. I
Okay.
have to first let you understand certain
Uh,
aspects of the market. Do you get it? So
okay.
let's just look at some example. Just an example, right? So even if we are to, let's go to the 1 hour time frame. Let me see if I can get a clear example of what I just demonstrated so that you can understand what I'm trying to say. So even this one is an example of what I was trying to say. I was trying to demonstrate, right? This one. So you can clearly see that, oh, what is my, what is happening? What is this? Wow, okay, wonderful. I hope you guys can hear me. It looks as if my internet is kind of breaking. I don't know why. But I can clearly see that over here they were selling. Can you guys hear me? So you can clearly see that over here they were selling and later they started buying. Do you get it? So when they were selling over here, all what they were doing is building liquidity. And then later on, they bought to attack those liquidity. If we go to the 4 hour time frame, let's see if we can get a clear view of the 4 hour time frame. So bear with me, bear with me. I don't know why my internet's okay, 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 cool. So even an example is even over here. You see this, the cycles, sell side, buy side. You see they will move and then later on they will sell and then they will buy and then they will sell. So that is how the market moves, right? So now when you go to the daily time frame, which is the time frame I usually use to find my buyers, but it doesn't mean you cannot consider the weekly time frame too. Doesn't mean you cannot consider the weekly time frame. So let's take something like this, right? Now, when you apply your internal range liquidity and external range liquidity, which we know that internal range liquidity is a fair value gap, external range liquidity is a swing high or a swing low, right? So let me just make a quick drawing of it. External range liquidity, something like that. Oh, okay, okay. So to save time, I want to save time. To save time, right? Let's take a look at this. Let's just use this to demonstrate something. So if you come to this current price leg, external range liquidity are these swing highs. This swing high, one, two, three, the middle one. And then this is also an external range liquidity, this swing low. And when you talk about internal range liquidity, it's a fair value gap. The fair value gap over here is internal range liquidity, right? And then change in state of delivery. Change in state of delivery is also external range, internal range liquidity. Breaker blocks, internal range liquidity. This change in state of delivery over here. Which of course, if you don't know what a change in state of delivery is, after this meeting, you can go and watch T-Trace Factor Mode, T-Trace video on change in state of delivery. Right. So currently, as I said at the beginning, you have to first find the structure of the market. So even if you're looking at it with your clear eyes, right, without even considering anything, you can clearly see that the market is moving up. Now, let us consider stuff. What is also happening? You can clearly see that we had this bullish FEG over here that the market got respected, right? And this bullish FEG was able to move price to break these highs over here, even including this high, right? So this will even tell you that the market is in a bullish trend. But apart from that, you can see that these down close candles are aiding price to move up, right? And let me consider this as our changing state of delivery over here. Is considering price, is supporting price to move up, right? And then another thing that you can even base on is that we are also disrespecting bearish FEGs. So where's an example of a bearish FEG in this? I'm not seeing any bearish FEG over here. A bearish FEG, a bearish FEG. Wow. A bearish FEG. Wow. What's this FEG? No. So I'm not seeing a bearish FEG. But if there were to be bearish FEGs, you get to realize that the market will disrespect those bearish FEGs. So one thing you have to understand about trading is that the market does two things. The market raises liquidity and then it provides fair value, right? So in other words, the market raises liquidity and then it balances fair value gaps, right? Because whenever there is a space, the market will come to fill that space. That is all what the market is doing. Do you get it? So if the market wants to continue this bullish trend, then we expect the market to come down to this internal range liquidity and attack this external range liquidity. Now, if the market does not want to continue the bullish movement, if the market is done providing fair value, we know that the next thing that it should go for is liquidity. So if the market comes to fill this fair value gap, the next thing it should go for is liquidity. Now, the liquidity can be this or can be that. So if the market is willing to move up to continue the previous bullish movement, then we expect it to go up. But in a situation where we disrespect this bullish FEG, then we expect price to come down for this external range liquidity. Now, you should pay attention because the next thing I'm going to talk about is very important. So you can clearly see that we came, respected that FEG, and then we moved up. I think we are not even down 20. Oh, it stops at the 4 hour time. And then you can see that we moved up to take that external range. Oh, yeah, we moved up to take that external range liquidity. Okay, so now this external range liquidity has been taken. Now there is no fair value gap over here. Let's see if the market will leave any fair value gap. So still no fair value gap. The market went ahead to take another external range liquidity and then it's coming down. I don't know what the market is doing at this point. Okay, so currently, right, currently we can see that this market is trying to change a trend to bearishness, right? Because I don't know why I'm not getting. I wish there was a bearish FEG here that I would disrespect it so that I can really use it to explain stuff for. But there is a bearish FEG over here. If it respects this bearish FEG, then we can clearly say that the market is changing the trend from buy side to sell side. So let's see what will happen. And you can clearly see that the market changed the trend, right? And immediately this got respected. That was to tell you that the market is changing the trend. I don't trade this pair. I'm just using it for demonstration. I don't know if I should use gold, but gold, this trade that I took, I have to break it down for someone. Okay. So what time was this? 12 December 2023. Well, let's still use this, right? So right now, one thing that you have to take note of, right, is how do you know when the market is ready to move from your internal range liquidity or external range liquidity? And this is where we are going to end today, right? Because I don't want to teach a whole lot of stuff so that after this meeting, new people can go over this. Now, this is how you know that the market is ready to move from your internal range liquidity to external range liquidity, right? And I usually advise my students to trade with the trend because logically it makes sense to trade with the trend and not go against the trend. So logically, if you're a patient person and you have a side business, you can choose to focus on 2 trades or 3 trades. Do you get it? Yes. I don't believe in becoming a full-time trader. I don't believe in that. It is me. Do you get it? I don't know for you. Do you get it? I like to do other stuff aside trading. No. Yes. So I don't like to sit at my computer all the time to trade. I don't like it that way. So I have other business I do aside trading. And I invest my most of my trading money in stocks and sometimes in crypto and then in my business. Do you get it? So how do you know that the market is about to move from this internal range liquidity? Now you get to know it using T-trade factor model or using candle closures, what I have been teaching on my YouTube channel, what I usually teach on my YouTube channel. Yes, you should find other things to do aside trading to even help you not to put too much pressure on trading. Because if you have a side job that is also bringing you money, you're not going to put all your emphasis on trading in a way that if you know that the market is not in a good condition, you won't be trading. Do you get it? Yeah. So that's the reason why I don't. Maybe someday I might be a full-time trader. It all depends on you. Well, so the first thing is you have to see this reversal signature. And immediately you see this reversal signature, then that is the market telling you that it's willing to move away from your level, your point of interest to the other point of interest, this reversal signature, where we have this being a first candle or a previous candle, and then the next candle closes inside the range of that previous candle. So this is the range of that candle. So if the next candle closes inside that range, then that should tell you that the next day is likely to go lower. And that is the reason why the market failed to close over like this and instead closed inside this way, right? So that is the same thing, and vice versa when it is turned around, right? That is the same thing that is happening over here. You can see that we took this candle and then we closed inside. So we can assume or we can say that the next day should come for this low. That is the main reason why the market is closing inside the range of this previous candle. So you can clearly see that the next day came for that one. Now we've taken this external range liquidity. We've also taken some liquidity over here. But this candle did not close inside the range of this candle. And you know that if you are trading this way, you are trading against the overall trend, right? If you are trading from fair value gaps to external range liquidity, you are trading with the trend. If you are trading from external range liquidity to fair value gap, you are trading against the trend. And I usually recommend you go with the trend. So currently over here, nothing, the reversal signature hasn't presented itself. Because for the reversal signature, let me see if I can turn, I can clone this. Shit. Is there a way I can turn this? The way I can turn it. Well, I wish I could turn it, right? So since it's not giving me that opportunity, that means I have to draw it to myself, which I didn't want to do initially. But if we were to get this at that external range liquidity, this candle, the this second candle closing inside, then we can assume that the third candle will go for this. And if so, so looking at this, right? Let me just let this pass before I teach one last thing. Stable network. Okay, so let's this one. Oh, I don't like it when my network is doing that. Yeah, just okay, cool. We had a perfect example right there. Let me just clear the chat. Okay, this is not the example This is not what I was talking about, right? This is not what I was talking about. That is not the reversal signature I want to see. Not even this. We will come to this very soon. But then, okay, so perfect. There is the reversal signature, right? You can clearly see that there was a fair value gap that we want to frame our trades from there. So you can clearly see that we can you guys hear me now? Can you guys hear me?
Yeah, now it's good.
Yeah, so what I'm trying to say is you can clearly see that when we tag this fair value gap over here, we took this candle's high and then we closed inside the range of that candle. And you can clearly see that the third candle distributed, right? Now, if according to basic candle closures, right? Okay, according to basic candle closures, which I want to do on gold, right? So is this good? Yeah, this is good, right? According to the rule of basic candle closures, right? Let's just use this one as an example. So the rule of basic candle closures will let you know that just basic, we are not applying PDRs or anything. Basically, right? If a candle comes and then it closes over the previous day's high like this, that is the market tell you that you want the next day it wants to go for it will go for this previous daily high. And that is the reason why it closed over, right? So you can clearly see that the next day we go for that, right? And then since we are closing over, the next day we go for that again. And since this one also came to close over, right? The next day we are likely to go for that one. And since that one too is closing over, that means that the next day we are likely to go for that one too, right? So since it's closing over, the next day we are likely to go for that one too. So I want to see the point where it will start reversing. So when a candle print this way, not taking both the high or the low, that is a consolidation. Let's allow the candle to see. So there was this fair value gap. We came and then we target. I didn't want to involve PDRs, but let me do it. But this candle didn't close inside the range of this, right? Because if you look at the reversal that I was talking about, I said if you have a candle this way, right, you want for you to trade, you want to just see this signature. So you want this second candle to close inside the range of the first candle this way to close inside. Take note of this, right? So if it closes inside the range this way, then you can assume that the third candle will open, print a low, then distribute upwards, right? But we're not getting that over here. But we are tagging a point of interest over here. So if we want the market to even move up from here, then because we didn't get that perfect C2 closure, so this is what I call perfect C2 closure. You wait for the third candle to print. And if the third candle prints and then it closes over this, right? If the next candle prints and then it closes over, then you can expect the next candle to also continue, just as I demonstrated over here. So let's see what will happen. So you see the next day didn't do that. So that took it and it's coming down. So let's allow more data. So if you listen to my video, I'll be saying allow more data, right? So you can clearly see that based on how these candles are closing, that is the market giving you a signal that it's not willing to go up. Maybe it wants to come back to the FEG again. And you know, we have this external range liquidity over here that has been taken, and we are getting that perfect C2 closure over here, which I don't usually advise trading against the trend. This is just for demonstration's sake. Doesn't mean go and trade against the trend. Always trade with the trend. If you gather enough experience, you can trade against the trend. So now we can expect the third candle to come from this level. Let's see what's open. If it will do that, we had a consolidation candle. So this is why I usually advise don't trade against the trend. So currently, I don't know what the market is doing. Let's see if we get any perfect example of what I'm trying to demonstrate. Perfect example. But this is where we go to. Okay, this is where we go to. Okay, so even at this point, right, just I just want to demonstrate that candle closure. So we took this external range liquidity or whatever, just a demonstration. Did we close inside? No, we didn't. So I'll wait for the third candle to see what it will do. And since we are closing over, we close over it. Yes, we closed over. So we are likely to come for that. We might come for that. So let's see. Everything's about probabilities. Wow, we consolidated. Okay, we definitely went down. But the thing is, you were expecting price to go down. So even if you were trading this, you could see that it was correct. It went down. But because this one failed to close over this, you won't be trading the next day. So let's assume that there was a fair value gap over here, right? There was a fair value gap over here, and you want price to move from that fair value gap to this external range liquidity, right? So you didn't get a perfect C2 closure, but your third candle closed over. So you wanted this candle to come for that third candle. So, but this candle failed. Immediately it happens that way. That means that you won't be able to trade this, right? And when this one even came, it also failed. That means that you won't also be able to trade this. But there is nothing, there is no data, or it doesn't make sense to even continue trading. So let's see if we get one last example. So that's we end our meeting. And then Big Ten, I think you've been watching the videos in the vaults, right?
Which one?
The
On
videos,
YouTube?
the videos in the vault channel.
Yeah, yeah, I did.
Okay, so even this one, you can clearly see that we are targeting a favor gap. We are in the bullish trend. We want it to go. Just a quick example. But we didn't get a perfect closure inside, right? And the third candle too is just painting some way. So for now, right? For now, what I am teaching is that we want to get that candle closure. So you can see that there was some kind of FEG over here. Okay, there was one FEG. Okay. It's taking us to the current price action. Wait. Oh, all this while we were on the 4 hour time frame. What the fuck? That was the reason why. So even looking at this current price action, right? You can clearly see that we had this bullish FEG. The market disrespected that with a bearish FEG. And then there is SMT over here. I know people know what SMT is. And then you can see that that means that automatically there is SMT with XAU written pound. That means automatically this one has tagged the FEG over here. So if price is respecting this FEG, then we want it to come for this external range liquidity. Now, how do we know that the market is going to?
Sorry, bro. Which pair do you use for SMT on gold?
I'll go over that before we end the meeting. So you can clearly see that we're getting that
Okay.
perfect C2 closure over here. I traded this C2 because I'm experienced, you know. So this, even with what I just taught today, you can find the bias of this. Big Ten, what would you expect Monday to do?
Uh, I think continuation bearish.
You expect Monday to deliver down to take this previous
Yeah,
daily low. Maybe
yeah,
probably even deliver more down to this one.
yeah.
Well, if it's closed over, then we can expect the next day, the next candle to come and continue, right? So we are going to end over here. Now, the pair I used to find SMT with gold is these pairs, XAU, EU, right? Gold, euro,
Mhm.
and then gold, Britain pound,
Silver.
British pound. Yeah, so we'll end today's meeting here. Silver is a bitch, man. Silver is a bitch. Silver doesn't really correlate well with gold. Fuck silver. So I will send a recorded meet. I'm currently having some kind of headache. I don't know why. So we will continue this meeting another time.
Okay.